Well, the U.S. economy created 187,000 new jobs in July, while the unemployment rate fell to 3.5%. Job gains last month were the least since December 2020 as the U.S. labor market continued to cool. For more, let's welcome in Joe Brusuelas, RSM chief economist. Joe, the big question is, well, what does this all mean for Fed policy? How would you rate the jobs report we got today in the context of inflation?
This is about as good a jobs report as one could get. It demonstrates a gradual and orderly cooling in hiring. We got a tick up in wages, which was largely a quirk of the calendar. That's going to come back. And what you see is that in that wage environment, right, we've seen it come down from 6.4% a year ago to 4.4% now. And that's while unemployment stayed below 4%. What that means is the Fed no longer has to hike. And that's indeed good news for financial market participants and the public.
So the Fed no longer has to hike. The question is, how long is this restrictive policy going to stay in place? We've got the two biggest hawks, Austin Goolsbee as well as Raphael Bostic, saying essentially that we're already in a restrictive stance, that essentially you keep elevated at these levels to keep inflation from reaccelerating. When you look at the numbers today, is that enough?
Yes, I think that is enough, and they are very restrictive at this point. We really just don't see a rate hike coming anytime soon. If the direction of spending, or excuse me, if the momentum in spending pulls back significantly, then perhaps maybe second quarter of next year, but that's at the earliest. My sense is we're going to be between 5.25 and 5.5% for some time. They're going to need to see core services ex housing really cool back towards the 2% target. Now, I got some good news for you though. New York Fed has a multivariate core trend that they take a look at. That's really the underlying trend, I think, in the preferred metric. It's at 2.94%. So we're not that far away. It'll be slow, but we'll get there.
I want to ask you, Joe, so when you look at the composition of the jobs that were added, you had healthcare adding 63,000 jobs, social assistance adding 24,000, financial activities, job growth increasing by 19,000, wholesale trade rising. What does the nature of this job growth tell you about the state of the job, of the hiring that is happening and the direction of the job market?
If I may, financial market participants made way too much of the 24,000 jobs created in social assistance. If you look at goods producing, if you look at construction jobs, if you look at trade and transport, then that education and healthcare, the preponderance of jobs created on the month were in the high wage categories. I mean, you know, I can't overstate this enough. At this point, you got a 4.4% increase in wages on top of a 3% inflation. That means we're seeing real wage growth. People are actually beginning to catch up, as it were. And I do expect to see several months of very strong wage growth as households catch up. You know, what's more important, though, is that because we're seeing real wage growth, sentiment on the economy, which has been undecidedly, you can't question just how sour it is, that's now going to turn, and that's good for the spending outlook.
So there have been some people we talked to. I think one expert we talked to recently said, you know, in terms of the direction of inflation, we can't just kind of sit back and expect it to continue to cool. It has been. What do you say to that? And is the wage growth enough to not just keep up, but outpace inflation?
Okay, the policy rate is above the inflation rate. It's above the core rate. That is sufficiently restrictive to bring it back down. Moreover, I think that China, which is now exporting deflation, that will begin to show up in the data going forward. Moreover, you're going to see inside the core inflation come back notably over the next couple of months. Why? Used car prices, which had been a problem for a number of years, that's really going to correct here. And then finally, and this is more importantly, rents. You're going to see rents, the way it's measured inside CPI, really begin to accelerate to the downside. We had forecasted this. We knew it would be a second half of 2023 phenomenon, and it's happening right on schedule. And so I'm very confident that we're going to see notable improvement. We're going to have a two-handle on CPI. By the end of the year, the core,
that's the Fed's goal.
The core PCE, you're going to see 3.5% to 4%. Not 2% quite yet. That's 2025 or maybe the end of next year. But we're moving in the right direction. And I don't think what we have to do is choke the economy. We just don't need to do it. We're going to be able to get back towards a tolerable level of inflation without creating a recession. It's what the Fed will begin calling, and I'm fairly confident in this, opportunistic disinflation, probably starting in just a couple days.
Okay.
So, Joe, are you saying no recession at all?
Well, we thought that we had a 40% probability of a soft landing. That's a non-trivial probability. And at this point, we've lifted our third quarter forecast to 1.7%. So I just don't see a recession here in the near term. There are risks. You could see the price of food accelerate because of what's going on in Ukraine. You could see the price of oil accelerate for a whole host of reasons. And of course, the tightness in overall lending that we saw in the senior loan officer survey, those are all risks. But right now, it just looks to me like the economy is going to muddle through.
And so, Joe, there's the argument to be made about Fed policy still taking shape. And we've heard this from Fed officials who've said, just anywhere from a few months to well over a year. If you consider that we're on the right path right now, what's the risk down the line that the Fed has already overcorrected? Are there concerns about that with the policy not having taken its full shape or impact yet?
I think you get a 9 to 12 month lag before you see the full impact of rate hikes when they're implemented. So the real risk is that you'll see consumer and industrial demand contract further or slow further and then perhaps contract due to the lagged impact of those rate hikes. Now we get to see that data quarterly. Now this past quarter, it was just released on Monday. It actually looks like it's beginning to stabilize, albeit at a very low level after 2 years of really big, well, not declines, but just a slowing in growth. And that's the story of the real economy is going to be told in terms of lending on the part of local and regional banks. If the Fed's policy, the lagged impact of that policy, really takes a pound of flesh out of that lending, then we could have a very mild recession. But at this point, with it looking like it's stabilizing, I just don't see that right now.
Joe, I want to ask you about something that you've written about. So we had data out early in the week, Jolts, showing that though job openings have come down, they're still signaling a tight labor market. Right. You have around nearly 9.6 million job openings. Meanwhile, the number of people searching for work is not quite half of that number, but it's a big difference, and you tweeted about this today, that there are roughly 5.2 million individuals looking for work. You compare that to the number of job openings. You have a unique solution to this problem. Right. Tell us about that.
Right, so normally at this point of the business cycle, we'd open up the immigration channel, and that's what solved the problem. Okay, just for the sake of argument, that's not happening. I'm not holding my breath on that. Workplaces, firms have really gone quite a ways in terms of lifting wages and providing flexibility. I think a full third of all workers are now working at home. Okay, at a certain point, you exhaust that, right? Wages aren't going to go up that much more, and, well, you can only work at home so much of the time. I think what's needed is we need to acknowledge the structural changes in the economy. There are more women in school than men. More women getting college degrees. At one point, we need to reshape the economy to accentuate our most important and productive workers, females 25 to 54. Okay. Once you go ahead and you acknowledge the obvious, then you begin thinking about what's the best solution, the most efficient solution to our workplace shortages. You need to begin to talk about childcare. Basically, 90% of men, 25 to 54 in the workforce. Only 77.5% of women in that cohort are in the workforce. Therefore, there is a significant potential gain by talking and creating a national health care plan. A national child care plan north of the border in Canada. By 2027, I understand it'll be only $10 a day for child care.
Wow.
Now,
I couldn't even imagine that here.
And when you go look at the research and do the research yourself, dig into the numbers, I think we can get an extra 7 to 8 percentage points out of the female labor force participation rate in that cohort if we were to do that. It looks to me like we know where the solution is. We just need to begin talking about it in order to arrive at an equitable compromise on how to achieve that. We were talking before the show, and I mentioned that often big change occurs, not because people are altruistic or even partisan. It's because you get a unique confluence of events. In this case, we have a massive workforce shortage that then requires innovative solution. And I think actually this is something that's going to be part of the economic narrative and policy narrative going forward in a way nobody would have expected just 4 or 5 years ago.
All right, you heard it here first. Joe Brusuelas, a solution to the labor shortage in America. A big thank you to Joe Brusuelas, RSM Chief Economist.